Thank you all for joining us today for our interactive automotive dealership panel. My name is Tara and I'll be moderating today's webinar. Please be advised that we are welcoming questions during and after the webinar. If you have a question, please utilize the chat feature in Zoom. You can either send your question to the group chat or choose to send me your question privately. We will address specific questions to the content covered during the presentation and hold general questions until the end. Today's webinar is hosted by Rosenfield and Company and the Presidio Group. Our panelists today are Ken Rosenfield and George Karolis. Today's session will also be recorded. We will have it posted on our website at some point tomorrow at www.rosenfieldandco.com. And with that, I'd like to turn it over to Ken, who is going to get us started today.
Thanks, Tara. I'm really excited today, actually. This is a different format. Today's going to get a nice little chat, and we have what I'm going to call the legendary George Karolis with us. He has a great history and background in the automotive industry, one that I'm sure most people have heard about or known. And I'm really excited to actually talk to George. I've actually heard of George for decades, so I've actually known of him for a long time. It's nice to actually do something with him for the first time. So really excited about that. And if you haven't been in tune with what's been going on in the merger and acquisition field, George just worked on what's at the moment, I guess, the largest acquisition of all time in the history of the automotive world. And that's pretty exciting news, especially during this time period and a lot of the press that this deal got. So, George, I'd be fascinated to know, how you got involved and what was going on with this and what led to all this. This was a pretty significant transaction, I think even more so than some of the other large ones that have been around because of the timing, what went through this. It was fairly well publicized, and it had its definitely a little bit of a roller coaster ride. So, compared to most other type of deals, this one was, I think, one for the record books, and you guys were well poised to deal with this, and maybe you can kind of what you can talk about what during this time and all that you had to go through. This was kind of like really leading the sheep through a pretty treacherous field there. So it's I think this is a history making event, and I'm really glad that you got to be in this and even give some insight of what made this one really special.
Thank you, Ken, and hi everybody. Honored to be here with everyone today. I think, Ken, you're talking about Park Place transaction, which aside from the Berkshire deal with Warren Buffett, obviously we say private, dealer-to-dealer transaction. We believe it is the largest in the history to date of the industry. It's an interesting way it came about. Of course, we had our firm had a relationship with Ken Schnitzer, the principal of Park Place, for years, for a long time. And Ken doesn't really have family in the business, succession plan in place, and had been thinking about this for some time and made the decision, probably at least a year before we actually went to market, and made the decision that he wanted to sell. He wanted to retain a couple of dealerships, and there was some thought process behind that as well. But in the main, he had made his decision that no succession, time to sell, time to move on, do things, slow down, and enjoy life a little more. Ken's an avid golfer and has a lot of, heavy in the real estate industry as well, a lot of investments in real estate, and had kind of made the decision that it was time. And a lot of planning went into that deal. Probably about a year before it was scheduled to close, we started talking with Ken and his family. And a lot goes into these big transactions. They're pretty, they're pretty intense. They're very big. It's not the average deal where there's dozens and dozens of buyers, and it's more, let's say, more strategic, and you're going to have a smaller pool of folks that can actually achieve it. Can pay for a transaction like that, can get approved for a transaction like that, and so it's a little different, and how you approach it is quite different. We planned this out for months before getting to market with Ken, and he, there's a lot of thought that went into a lot of planning, a lot of due diligence, a lot of strategic work, and how to approach it, who to talk to, how to hit the market, how to keep it quiet. Typically, ironically, a lot of these industry, there's a lot of rumors in this industry and a lot of things leak. That deal actually kept, I think we believe, pretty quiet until it was actually announced. And typically deals don't get announced when an APA is signed. In that case, it was announced by Asbury because it was a material transaction. So they, by rule, as a public company, they had to announce the transaction. And so, in December, sometime, I forget the date, December of 19, it was announced to the world that Asbury was buying the deal. And so actually it was kind of pretty public, right? Most people kind of knew what was being paid and sort of knew all the details about the transaction because it was announced. And then of course COVID hit a couple of weeks before the deal was supposed to close, and the roller coaster began for sure. Interestingly, because it was such a public deal, and the world knew about it, even though Asbury had to, because of the uncertainty, had to back off the deal, and there were a lot of reasons for that. The phone really started ringing after that. After a few weeks, I think everyone was kind of on pause and didn't know what was happening in the world in mid to late March. But our phone was ringing off the hook, and there was a lot of interest in folks calling, asking about the deal for a while. And one thing led to another, and ultimately as things settled down, Asbury came back to the table. There were a lot of other folks interested as well, but Asbury came back to the table, and they had sort of a head start, if you will, on most, because they had done most of their work already, and the deal came back together, and we're pretty pleased that it closed just a few weeks back. But what a roller coaster ride that was, for sure. We also did another pretty large transaction in Texas as well, the John Eagle Group, 11 stores in Dallas, Houston, and Austin. That also closed in the last month or so with Lithia. Another pretty big transaction, and that was actually underway before COVID as well. So deals are happening, and big deals are happening for sure.
George, what do you think with these two big deals you've all worked on? What do you think that's done to the marketplace in terms of value of dealerships? Some people have been really concerned that the value has been going down during this time, and you have these two large transactions closed with publicly held companies, and we get a lot of questions all the time. Actually, we're inundated with valuations right now, and dealers are asking what's the value, what are we worth. So what's your perspective on the value based on these cases during this time?
I don't think these two transactions are dictating or changing the landscape of value. They're just another couple deals, high profile, but there's hundreds of deals that happen, and I think we'll see more deals actually. We'll talk about that, I think, in a little while. I'd say, interestingly, if somebody, I'd say in April or May, if there was a deal in process or a new deal hitting the market, there was a lot more uncertainty still back in that period. There's always a one-off situation or a unicorn or a deal that is just such a great deal that nothing matters, and whatever the current environment is doesn't matter. But I'd say back in that period, there might have been, there were few. We didn't hear about many, but there were a couple deals that opportunistically kind of value was probably. A buyer might have gotten some good value, if you will, versus a normal market. But I think that all pretty much quickly went away when the world realized the dealer model was intact, and the personal vehicle became king again because of safety and mobility, and everybody wanting, shunning mass transit, shunning ride sharing, shunning anything having to do with safety. Personal safety and mobility, which really led to a rise in vehicle sales, and of course there was pent-up demand as well. And when you add to it the historically low interest rates and availability of capital, the model was proven, and that value proposition came right back. And as of today, I'd say sitting here today, dealerships are as valuable as they've ever been. Today, we're in the last few months are dealers are on top of the world, are making record profits. We were talking before we went live here about margins, right? Margins, because of inventory availability, have been very strong. They're going to level off again. I mean, production is going to come back in the next few months back to normal. But because of lack of inventory and pent up demand, and both on the new and used side, we saw sort of really record margins. Expense structures were reduced, rates came down. All those things created a perfect storm for some amazing perfect storm of great profitability for dealers the last few months. You know, those that think that'll last forever, you know, be careful, right? But you know, the model's here. It works. It's resilient. It's highly variable, so dealers can flex, right? And so the model's just been proven again. You know, values are going to be stable for sure. You know, I mean, you know, no one's going to get paid based on what they did the last 2 months. The trend the last 2 months for sure. You know, folks are going to look at history and you know, a lot of historical data and take that into account. But
That's a great point that no one's going to get paid over what they did last 2 months. I think that's a real key thing.
We have a client that is, you know, says, hey, I just had the best month ever last month, and so I want to get paid based on that run rate. So that's not going to happen. You're talking to the wrong people if you think that's going to happen. But you know, there's a balance there, right? And there's a lot of data points that are used in transactions, of course.
So George had a good agenda here, so I'm going to go ahead and let you keep on talking on your agenda. It's really some good information here.
Before we dive into this, George, we're having some issues with your audio kind of fading in and out. So I don't know if you need to go closer to your computer or what your microphone situation is, but we've had a few people. I don't know if you have an external mic or. I'll keep you posted as we go, but it's very.
Okay, I'm going to try to talk louder. How's that?
Perfect.
Better? Okay.
Now. Excellent. All right.
Okay.
So I've pulled up a topic here that I know, you know, we wanted to get to discussing was really the automotive market today. So I'll let you guys go at it.
All right.
Oh, what? Go ahead, George. You were the.
Yeah. Sure, no worries. Yeah, so I mean, I think we just touched on some of it, of course, right? But if we talk sort of macro, we hit on obviously inventories and pent up demand, and you know, that's really the last few months have been incredible for sure. You know, the 6 publics are pure proxy, right, for value, and most of them are at all-time highs, with Lithia, of course, being off the charts, and they're just incredible what they're doing. I mean, their market cap is, gosh, I think it's 30% higher than any of the other publics right now. And so, you know, the public companies are sort of proving, you know, what we're all seeing privately and in the main, that dealers are doing very well. Sales are back. You know, the dealer model's intact, and the market is as strong as it's been in some time, for sure. And who would have guessed that? You know, sitting here in late March and early April, for sure. We use the analogy. So people ask us about the deals that we've done, and we kind of talk about, you know, we talk about kind of tech companies and Clorox and things like that. And say car dealers are sort of like those companies right now, you know, because of the popularity of the personal vehicle. So I mean, you know, on a macro basis, the market is very robust. You know, dealers again are faring very well, or having record profits over the last few months. You know, obviously we have some headwinds coming at us. We have an election, uncertainty with an election. We have, you know, what will the long-term impacts of the pandemic and the economy be on the industry? There's always geopolitical issues out there, so you know, we have some potential headwinds coming at us. You know, we think for now the market will remain strong, and you know, that'll take some time to sort of catch up if things turn the wrong way, of course.
I had a question for you. Some of the deals that you've been working on, such as the big notable ones, have been with publicly held groups and access to public funding. How do you see the banks reacting to the smaller deals of the publicly held companies that are being financed by traditional banks or to other capital? And what do you think the bank's appetite has been to some deals, maybe not as large as you're looking at, but you know, some smaller groups or single point stores and that kind of thing? So we're getting a lot of questions on that too. So I'd like to be interested in your perspective on smaller deals and how banks are financing these, if they're financing these, and what they're looking for.
Yeah, no, that's actually a great question. We talk a lot. We always talk a lot about publics because they're there's public information, so we can just Google public companies and everything pops up. But less than 10% of the historically less than 10% of the deals that happen in the industry are by publics. They're private to private. So 90% of deals are private to private. Hundreds of deals a year, right? Private to private. And there's hundreds of buyers, private groups of all sizes. What we find is sort of the medium to large size private dealer groups have really strong banking relationships. In a lot of cases, lines set up already, acquisition lines set up where they're sort of plug and play. We had a blip here, with COVID, right after COVID, with a lot of the banks reacting and not knowing what was going to happen. But I think we're sort of past that, and we're seeing the banks kind of come back here and get back to normal in the main. And so those acquisitive groups, private groups that have those relationships are sort of moving forward and they have those commitments from the banks. A couple of them have tightened up, and I think it's their underwriting is getting tighter, and they're spending more time, if you will. But rates are at historic lows as we've discussed, and capital is out there. It's available. Banks putting it to work. The model's proven itself, and so we're finding that lending is there, and for well capitalized, reputable folks, deals that are strong, that have good underwriting behind them, that are going to prove themselves out, are I think that's wide open.
And what do you think about some private equity groups? We're starting to see some fusion of interest from the private equity groups as well, trying to break into the market. And some of the pushback that we've seen is from the manufacturing side. Manufacturers, I think especially after the deal in New England, where maybe they're getting a little fatigued with dealing with traditional non-dealers and the private equity backing. So there's like some groups that do have private equity backing, but the dealers, they're just backing the dealer in the financing sense. And then you're also seeing some private equity groups that I think want to get into business. And there's been a big kind of puddle in the road there with what happened up in New England. And I think that's getting straightened out, but to some degree. But I mean, how do you forecast or see what private equity groups are looking at in their interest?
Well, look, if I had a dollar, I've been at this since the late 90s or so in this industry. If I had a dollar for every time over each year since then, that the buzz was, hey, private equity is really interested in private equities here, and there's a lot of interest in private equity. There'd be a lot of cash stock piled up in front of me here. There does seem to be a little bit more interest from private equity. There's a couple groups, a couple dealers that are backed by private equity, like mainstream dealers that have private equity behind them. Family office is another one, obviously, that we think is actually more viable. We're seeing more family office, pretty aggressive in the space. But you're right. Look, Asbury, for example, was a private equity play in the late 90s, and look, framework agreements, a lot of them came about because of the ownership structures, fragmented ownership structures that result from those types of investments. And it all comes down to the operator. And is there an operator with a proven track record that has skin in the game? That's the differentiating factor we find for those groups, investors, whoever they are, private equity or anyone else, that they have the right operating partner that is the face with the OEM that can help with the provability, that can provide stability, that can check off that box, if you will. That's a differentiating factor. We talk to a lot of private equity groups, a lot of investors about that, and that's the first thing we talk about when we talk to them, bring them to the table or present them deals. We get calls all the time from various investors, including private equity. There's more buyers and more investors than there are deals. by a multiple for sure.
Absolutely.
But, you know, again, but it doesn't mean everyone can get approved. Everyone can check off the right boxes.
Yeah, it's my understanding. I talked to some of our clients on dealer council, and we talked with some of the manufacturers, especially Toyota, which is, you know, had the biggest problem, I think, up in the New England area. That I think they're going to take a lot harder look at qualifying these private equity groups coming in or backing dealers. If they're going to back a dealer, like there's some of them doing that, they're going to have more demands of who's running the stores and who's going to be the face of the dealership group versus the private equity group.
Yeah. Yeah. And private equity, look, historically, there's an exit, right? Funds have exits.
Right.
And you know, OEMs, there was a group I forgot what it was, a story in Automotive News, a group that publicly said, hey, we're going to buy these and then flip them. And that's not really what the OEMs want to ultimately hear. You know, they want stability, obviously. So to your point, there's probably some more scrutiny coming.
Right. Yeah. It's going to be an interesting dynamic.
I have a question from the group here. There's a question for, and I'm not sure if we want to hold this, but a specific question was asked on how are dealership valuations being impacted with the rise in e-commerce in auto retail? And how is the growth of Carvana and CarMax's omni-channel proposition impacted franchise dealers, and then on to valuations?
Well, I'm not an expert in public company valuations, but I think Carvana has something like, last I checked, a high 30 something billion dollar market cap, which is, I don't know, at least 10 million higher than all the public automotive retailers combined. And their sales are a lot less than all the retailers combined. So it's, you know, I don't know that Carvana, I don't know that that the Carvanas of the world are really correlated or impacting the valuations of the pure publics or private dealers in general, right? I think, but they brought some more buzz. But the overall digitalization, and Carvana is a big player in that, which is, you know, partially probably why they're doing so well. Digitalization, you know, was highly accelerated, extremely accelerated, obviously. You know, yeah, I think everyone knows this, accelerated because of the pandemic, and it's here to stay. And so, you know, the model's changing. You know, if you don't offer digital tools and you know, a touchless, potential touchless process, or, you know, a process that way, you're at a disadvantage as a dealer. And that's only going to, you know, increase, I mean, customers. But look, there's a subset of customers that are always going to want to go to the store and touch. This is the second largest, if not the largest, purchase in a lot of customers. And so there's a subset they're going to want it the traditional way. There's a subset that want a full digital process, and then there's the all the way in between that, right? And so, but it has accelerated by many years, digital for sure. Look, it costs money, you know, as well, but it does and will and should lend to you know, expense efficiencies over time at dealerships as well. So that investment should be offset. But you know, it's why we saw we're seeing some consolidation. We're seeing some sellers that are thinking it's time to sell, because, you know, that world is changing so much. We're seeing buyers or private companies, medium and larger ones, wanting to get even more scale and grow and buy more deals so that they can, you know, have more synergies because of the digital play and digital commerce. And so it's across the board, but it's here to stay, and it's only going to, you know, increase from our perspective. But, you know, they'll every customer, I think Lithia's kind of said it pretty well in some of their public remarks about their driveway initiative, that, you know, there's a lot of customers have different preferences, and so, you know, the ability to you know, provide the different customers that have different desires the buying experience that they want is ultimately what's important here, and that's not just traditional brick and mortar anymore.
Ken, any feedback from you on what we're seeing from the accounting side in that aspect?
We're seeing it's like some weird paradigms, and with the no new car inventory available. We've had traditional dealers, like some like in the Washington, D.C. market that have traditionally sold new vehicles, all of a sudden have to learn how to sell used vehicles. And they've seen grosses that they've never seen before. And then that's with the cost of used vehicles going through almost the roof and being what new vehicles are costing is somewhat mystifying to a lot of our clients. And now they're seeing that and like Toyota, they're starting to get filled up with new vehicles again. And it's like, how do they deal with that? And then already in the first couple of weeks of new inventory on the ground, they're going back to their old ways. And so some of the conversations I've had with some of our clients have been, the good habits are made in the bad times. And you just experience what it's like to get great grosses on used vehicles. And you've learned how to acquire used vehicles and market used vehicles, and you use a different type of marketing manner, the same kind of methods with digital media and all that, but you're selling a used vehicle. How do you keep those grosses back up? And they're already kind of reverting back to their old ways within the last couple of weeks because new inventory is available. So it's how they deal with that and how they react to continuing with some knowledge of how to get a good gross and keep that mentality going. It's been difficult for a lot of dealers. They revert back. And then we talk about how that impacts what their value is going to be if they just go back to their old ways. And so retraining or re-educating them or trying to think a little different way of how to deal with things has been somewhat difficult. And we have some other clients now that they're still paying all the money for used vehicles, for just getting something to sell in inventory, and are paying basically market price to obtain a used vehicle, and they're still able to get a good gross on it. So we're still seeing some of that in certain areas as well. And, to me, what's gonna, I like George's opinion on this. It's, how do dealers react to the market and able to deal with what's going on? What impact does that have on their saleability or making them attractive to be an acquisition or put them in a position to buy someone else?
Okay. I had another question from the group, if you guys don't mind. Previously, George mentioned having skin in the game. Question is, are you seeing more deals where the GM is taking a stake in the business, and what is the significance about that?
Not really. Meaning on acquisitions, as a GM owning a piece, I'd say it's pretty. It hasn't really changed much. There's a lot of dealers, buyers. Think about Terry Taylor and folks like that. That's part of their model. They want their GMs to have skin in the game, but I think it's only the skin in the game comment was more about investors, buyers that to get approved, you have to have that dealer experience, that dealer operator. There are some buyers on certain types of deals that desire the operator, if you will, albeit whether it's the GM or the dealer principal, whoever is really driving that culture and driving the earnings and sales of that dealership. We see some buyers that want those owners or operators to stay in for a percentage, some 10-20%. We do see that. We did a deal earlier this year that our client, we didn't publicly disclose the deal, but our client retained a 20% ownership in the deal. They wanted to retain it, and the buyer wanted them to stay in as well as a bigger buyer that didn't have really operational presence there. And so it's across the board, but it's not. I wouldn't say there's anything changing from historical norms there per se.
Yeah, I think that's a good statement too. I don't see where anybody buying a store unless there's some magical GM in there that really makes the thing stick or it's worthwhile buying it. And that's maybe part of the goodwill. If someone's that spectacular, they might put them in. But I think someone's going to be buying a dealership group, especially of any magnitude. They're not going to be too concerned about one specific GM or something like that. Right. But I think you are seeing, we'll see as we have a transaction meeting with the client tomorrow, actually. on the possibility of his GM buying more shares. And that's going to be part of succession plan because he doesn't have children to go into the business. And so he's looking at selling to the GMs, which is a transaction. And it does, how we value this thing and what's going to be components of how this thing is valued. Do you use a traditional method? Does COVID still have any impact? What's the lingering effects? And those kind of things. And if it's going to buy a significant share, and George, I don't know if you get involved in this kind of thing or not, of let's say a GM is going to be taking over is succession planning in a dealership, is this something where they would go outside to somebody else to help them, or just use more traditional succession planning techniques? And what's the value to do that, and how they finance it? Banks willing to finance something like that, especially in this market. So.
Yeah, we see that from time to time. Usually, dealers hires a firm to do a valuation. So they understand what the market value is, mostly the goodwill, obviously. And we see dealers. We don't get too involved, right? Because they're usually sort of kind of happening. There's not a market deal, if you will. But we'll see. We'll see owners finance a deal for the GMs in a lot of cases, and in those cases, in a lot of these cases where a dealer is loyal to the GM who helped really create that business that ultimately they want to transition and figure out a way to help that they consider them family and help that GM ultimately take ownership, and so they'll finance them or give them a deal. I don't know that it's the best. It's probably not the best way to maximize exit value for an owner, majority owner, but it's sometimes things aren't just about money.
Yeah, and also that's exactly true about the money. I mean, this is the case also. If the GM's got a great reputation, a solid reputation, manufacturer and other vendors, and that goes a long way too. But you're right. I mean, it's not going to be cash in your pocket kind of deal to keep on walking from that. But this is another question I have: is you guys publish that? Is what people publish these multiples, and we have a lot of conversations with our client. It's always one of the first questions, what's the multiple? I mean, do you see that still being the big driving force behind all this or not? When we say, hey, what's the multiples? Like, what's your response to something like that?
My favorite topic. The thing I always say is I hate talking about multiples.
I do too, by the way. So.
I hate it. It's a problem with multiples is everyone thinks about a multiple differently. Multiple, whether is it multiple of EBITDA, is multiple of pre-tax income, is it adjusted, is it unadjusted, is it on the trailing 12 months, is it on last year, is it on a 3-year average, is it on future? We have some buyers talk about multiples, and they're actually talking about a multiple they paid on what they're gonna make in a few years, and the biggest mistake I've seen dealers make, sellers make, is hearing that someone got paid some multiple and that's what they deserve and that's what they want. And every single deal is unique. They're good general barometers for things. There's separation between Mercedes and Chevrolet, just not to single out any deal, but high lines in volume imports and domestics, and then the values. There's separation. It's usually on average 100 basis points or something like that. And so you see some of our friends, some are on this call, publish reports and talk about the general market multiples, and that's good. Look, it's a good barometer, and effectively it shows that separation between brands. But it's a dangerous game to ever talk about this is the multiple you're going to get, or this is the multiple I want, and because you're never talking apples to apples. A buyer and a seller are never talking apples to apples. It's also a dangerous game in negotiations to actually say, well, I'm going to pay you X multiple, and because then if X is on something, then it creates really a lot of issues, in due diligence and ultimately finalizing a deal. And so what we focus more on ROI, and look, when we with every one of our clients, we do evaluation, and we look at their historical earnings, but we look at their sales effectiveness. We look at their facilities. We look at the market they're in, the growth prospects, the competition. We look at whether they're underperforming or overperforming. we look at all kinds of variables and then apply market data to that to sort of come up with a range of value on what they're worth. And it's not really just driven off of a multiple on a period of time of earnings and whatever that earnings is. There's a lot that goes into it. And so it's a dangerous conversation to get into, but it is, it does put a stake in the ground somewhat to help drive when you use all the parameters that we just talked about, and there's a lot of different things that go into it that go into ultimately what a value is. Because when we bring a deal to market, we're guiding buyers. Buyers are asking us, well, what's this deal? There's not a specific ask price, but hey, the X, Y, and Z, the historical earnings, the market they're in, the upside potential, the sales effectiveness, the competition, this happening, that happening. There's a whole slew of things that impact value, and we talk to the market about that in terms of guiding value. And it's not really just they made $1 million and they're going to get six multiple, and so the price is $6 million. It just doesn't really go that way.
George, you mentioned one word 3 times, and I was focusing in on because I use the same word all the time with clients. It's going to be a driver of value. And then the question is it a driver up or a driver down? You mentioned the word sales effectiveness. And I drill this into our clients all the time. We do evaluations. That's one of the first things we look at is what's the sales effectiveness. So I'd really like to know what your opinion is on, if, let's say they're 115% of market or 60% of market. And I've heard everything from, yes, it makes it go up, makes it go down. So I'd really love to hear what your opinion and your thoughts are on how sales effectiveness really impacts value.
That's a loaded question too. There's not an answer. There's not actually a perfect answer for that either, right? Because obviously it's a formula-driven deal, but the different every OEM is different, every market's different, the way a market's cut is different, the way the competition is laid out is different, and so it's one barometer. Obviously, if something, we've seen deals that are at 30% and some that are under 80%, and there's something driving that, and so we have to get to the bottom of what's driving that. But sort of ultimately UIO and the competition and what the rest of the market is doing and what the historical trends are, all the factors we talked about in the previous question sort of play hand in hand to that. But look, generally speaking, if I'd say the market thinks that, hey, if something's, if a deal's like 200% sales effective, that's, I'm afraid there's not going to be as much opportunity or upside opportunity for that. And versus if the market sees 50% sales effective, they ultimately think, oh, I could do better. There's upside. So I'd say those two examples are outliers. But that kind of, puts up the goalposts, for how folks think about sales effectiveness. But there's so much more that goes into it than just saying, well, here's the number. So there's an outcome because of that. That's standard in the market.
We've
go ahead.
2 schools of thought sometimes, and exactly what you said there is if its sales effectiveness is real low, that's an opportunity for the buyer to get some high ROI. If the sales effectiveness is 200%, well, that's pretty hard. That's a big hurdle to jump over. It can be kind of tough to maintain that.
Yeah, I mean, the planning volumes that are set by the OEMs, you have to, sometimes you wonder if they're accurate and where they came from too. So sometimes those are out of whack, and there's just a lot of drivers to data points. So there's just so many more things to consider in evaluating a deal and the opportunity and the upside or lack of upside.
Right. What do you see in like current deals and the timing that's allowed for due diligence, and what the focus might be on due diligence time, and who should be looking at it, and what should they get into the staff at the dealerships to do some due diligence, or how would they go about looking at that?
Yeah, most of I'd say most you got to sort of, there's a couple of different types of due diligence, right? So I usually kind of bifurcate and say financial operational is one, and then sort of facility, real property is sort of the other, right? The two main ones. There's a lot of other moving parts, HR and legal, things like that. But those are the two key ones that sort of drive timing. And I'd say the financial one is relatively faster, should happen quicker. Every deal is different. Every buyer is different. And what we try to do is upfront set an expectation in the process with buyers and say, this is what our expectation is. This is what you have to commit to on due diligence. And it's generally a quicker time frame than a lot of buyers would want. But there's no look. I did this all my life. I was a buyer for 18 years, and before that, I was a diligence guy. I started my career at Anderson as a diligence person. So, we understand this, and so there's no reason why diligence can't be done quickly and get wrapped up. We don't want uncertainty for our clients as sellers. We don't want to get into a deal where a buyer can just kind of drag things along and have outs, if you will. And so we try to dictate up front and get an agreement up front where diligence is going to be done pretty quickly and generally speaking before an APA is signed, parallel path with that APA negotiation. Sometimes that doesn't happen, and that's on the financial and operational side. Real estate, that takes a little longer, but real estate, there's less uncertainty, if you will. A lot of the real estate can be kicked off up front, and we're talking about appraisals, environmental work, and property condition assessments, inspections, property, and then of course there's title and survey. That's just your typical real estate buy sell type process. Environmental is the one that'll take the longest. If there's something that's found that requires additional testing, mobilizing, getting that testing done, that could take longer. But that's, you can define that. Sellers can upfront say, okay, look, as long as you sign off on everything else, if you need more time for environmental, no problem. But if you find anything, we want the ability to fix it or talk about it without you saying, hey, well, it's a way I can get out. And so again, setting expectations up front and managing through that process up front, knowing what you're doing so that, there's no surprises and there's no I gotchas and there's no avenues for buyers all the way deeper into a transaction, especially once the transaction gets to the OEM for approval and gets out there in the world, there's less ability for a buyer to kick out.
I had a question from the group. George, I think this one is for you. How many big deals similar to Park Place can the market digest? Do you feel that there are more buyers out there for deals of that size and more?
That's a great question. During the Park Place planning, that was a big topic. That was a big discussion point. And if I was answering that question then, I'd say fewer. Answering it today, I'd say there's more buyers that can digest large transactions like that than we would have ever expected. And I think some of that's a function of just the market changing here just in the last year or so, and a lot of the new entrants. But it's also just a lot of reasons we talked about the resiliency of the dealer model. But we think where we thought it was a handful. I mean, there's a lot more buyers that can then do larger transactions. And it's not hundreds. But it's more than just the publics, if you will. And we're finding, if you just look at public data, I mean, if you look at what Lithia is doing, for example, all the deals they continue to announce, there's more capacity for buyers. And look, as buyers even do bigger deals, if a public company buys a deal, well, that cash flow gets added to their bottom line. They have kind of a new basis, right? A new base. And so we've got, we actually expect there to be more larger transactions. We've got one that we're working on right now that is not at market yet, but it's pretty decent size. So, and we hear there's others in the market, and we're talking to others. And so, it's just a natural progression. We were wondering over the years, hey, when's this going to happen? It's just a natural progression of consolidation. We're still a pretty fragmented industry in terms of consolidation, and the needle has not moved that much since consolidation started. Believe it or not, it's moved a few hundred basis points, but it really to the big players, but not as much as most other industries do. And there's still over 8,000 dealers, right? Over 16,000 dealerships. And so, just a natural progression. We'll see some more larger transactions. There are plenty of buyers that can digest them. Look, the same buyer probably can't digest too many. Maybe they could do one or two, and depends on the size. But it's pretty open.
Moving on to evaluating 2020 performance.
That's a great question. So if I was answering this question in June, my answer was we're throwing 2020 out the window, because basically March, April, May, that's three of the more important months of the last 5 or 6. Sitting here today, some of the conversations we've had with our clients that have had really good months the last few months, that have offset the prior few months and sort of almost at a normalized basis, we're starting to be able to use some form of 2020 year to date, as a barometer, but a lot of folks are still paying more attention to pre-COVID earnings levels. We've had it, and it's a little bit market by market. Some markets were shut down harsher than others. Some didn't shut down much. It's a little across the board. So there's not a cookie cutter answer here, but I think in the main, you can see now sort of things sort of leveling off, normalizing. Obviously the PPP money has to be pulled out if dealers recorded that in, but there's anomalies though, and so you have to do some digging, and so every deal is going to be different. Did if there was a group that cut staffing tremendously and didn't bring it back, or was in a market more heavily impacted with shutdowns, it's going to be less relevant versus more, some markets in Florida, for example, that really sort of a lot of them are business as usual, save about a month or so. And so it's market by market driven, but as more time passes, and sort of the first few months of COVID kind of have been offset by the last few months, and then things come back to normal. We're starting sort of able to continue to add that to the historical looks. But 19 sort of to date, 19 run rates and with some thoughts on future and things like that have really been more of the drivers of valuation, even to date.
You think with the manufacturers now turning on the inventories, and certain manufacturers actually now starting to open up the gates with new inventory, the impact that will be, like we talked to some of our clients, I mentioned earlier that they're kind of going back to their old ways now that the inventory's in, they're fighting in the marketplace and going back to low grosses again.
Yeah, look, these high margins aren't going to, they're a function of inventory availability and pent up demand. They won't last forever. I think, but most dealers have gone through a good learning lesson here, and but I still say the ones that think this is going to continue, it's just be careful, right? I think history will repeat itself, and things will just normalize. The balance, it'll come back into balance, right? And the dealer, I think every conversation I have with our dealer clients and those buyers that we talk to, or every conversation is the same lately in the last couple of weeks, is, hey, we're just looking at a couple 2-3 months of being back to normal production levels. And when that happens, the OEMs, they don't like to be shut down. They don't like to not be making cars, right? So, the supply and demand market forces will prevail for sure, and history will repeat itself.
You see this as like a buyer's market or a seller's market, or does that depend as well?
Oh, it's it's a buyer's market. It's a buyer's market. I don't know how long that will last, but it's a buyer's market. The market is more active and stronger than I can remember. There's more deals though as well, right? And so the more deals ultimately, ultimately, if there's too many deals, right, that shifts. I think for now it's a buyer's market. That could change tomorrow. If we knew the answer, we don't own private islands, we wouldn't be on this webinar. But we just looked to history, and I think the biggest mistake people make is thinking that things last forever. And you can apply that to life. You can apply that to any situation in life, and the stock market, whatever it may be, right? Nothing really does continue, and things go in cycles. Right now, because of really the resiliency of the model and the strength of the personal vehicle and the forces we talked about with OEMs being shut down, I mean, they've resulted in some really good dealer strength. Dealers are feeling really good, but with over 8,000 dealers, there's different mindsets, there's different strategic futures for those dealers, and so there's still a subset that have no succession, or that are close to retirement or at retirement, that want to sell, or that want to slow down, or there's still those that are pure financially driven. It's just another deal, and so those dealers say, hey, this is probably a good time. And then there's, of course, the other end of it, generational dealers, obviously the publics, but generational private dealers that have 100-year luck on this, and will keep moving these businesses from generation to generation, that are looking to buy. And so it's across the board with how many dealers there are in our universe. But I think the mistake, those that have a thought to sell, that are thinking about it in the near term or in the midterm or whatever it is, whatever the case may be, those that are planning on it at some point. What we have learned is time is the enemy of a successful, plan or transaction. So there's, waiting doesn't make sense in our opinion. Like if that's your plan, then why wait? Because you don't know what catastrophe is going to happen tomorrow, what geopolitical issue could happen tomorrow, what economic issue happens. We don't know. COVID. Now, thankfully, we came out of it really on the better end of it. Then I don't think anyone could have thought that we'd be where we are today. Thankfully, we came out on the right end of it, but that could have went the other way. And the next one, they could go the other way. So if that's the plan to sell, don't wait. And again, it could flip to a seller's market easily with a supply-demand imbalance, or something can happen unpredictable, and things happen all the time that are unpredictable. So if that's a plan, there's no reason to wait. It's like, get going yesterday. That's our general advice to folks. But if that's not the plan, then don't wait. Don't get going. It's okay to retain these things. Are good investments. If you have a long-term approach to this, these are good businesses. We'll talk about disruption soon and what that ultimately means down the road. But there's some good runway here for dealers. There's going to be ups and downs for sure. There always are. We won't make these levels of profits that we're seeing the last couple of months forever. But most dealers have been through cycles.
Did we have any additional? I know we kind of covered some of this already on the transaction news. You think we're settled here, and maybe move on to disruption talk? I know we're kind of getting closer to 3. Did you have anything to add to the topic we had previously discussed?
No, I just say that a lot of our friends that do what we do and what we're seeing in our book of business, we expect the next couple quarters to be very, very active on the buy-sell side. Very active, more active than we've seen.
Yeah, I would agree. We're seeing the same on the business valuation side for sure. And getting to the disruption and the impact on dealers, I did have a question, come up that's kind of relatable to this. As far as everything going on with COVID and things moving to e-commerce, how broadly would you say, how are dealers, like how many dealers would you say are ready for full e-commerce? Like percentage of dealers today that could sell a car 100% online to a customer who never comes into the dealership?
I don't know that question. Not many. And some of that's regulatory driven, right? Wet signature driven, if you will, the buzzword wet signature. Few. I mean, few. I mean, I would be our take. I mean, from a traditional dealer's perspective, I mean, the publics are doing a pretty good job with it. A lot of privates are doing a good job with it. Defining what 100% digital means, right? That's, if it's truly like Carvana 100% digital, if that's the question, fewer than more. But I think folks have really ramped up and can provide that. It's just, what does the customer want, and is it practical? We just bought a car and it was mostly digital, but we then picked it up and had to do a few things at the dealership. And I don't know. I don't know that the customers are really fully expecting that right now for all the reasons we talked about. But
yeah, Carvana is interesting because their value is so high. They have such a funky business model, and they're definitely driven. But I've even seen some copycats, trying to do the same glass vending machines and things like that. See, there's a few here in Florida that try to copy that. But there's some other things that I think that they've been very innovative with in their advertising and delivery methods. I think other dealers are taking on as well. So I think there's some impact there. But what do you think about what the level of Tesla has been doing, or how they're reacting to the market, and other non-traditional retailers, what impact they could have, or if you think anybody might try to follow suit with what they're doing as well?
Yeah. I mean, go ahead, Ken. Sorry.
No, go ahead.
No, I was just, I think we were talking to, we actually saw Michigan pass an interesting law that isn't going to allow much of that anymore. Right? Tesla's, I think, kind of grandfathered in. So think about that in terms of the strong dealer lobby, right? But we were talking to one really large group, large dealer group the other day, and it resonated with me that they have a full digital process that they offer, but they're seeing single digits in terms of customers that are
Yeah, I agree with that too.
Wanting that, so customers aren't there yet, even though they're using a lot of pieces of it, if you will, and starting the process digitally.
Tara, we have a few minutes left. Do we have any other questions or anything?
I don't see any. I think we answered them all. Again, if anyone has any quick questions for the gentleman before we wrap up here, I'd be happy to ask. But if not, my contact information is on your registration. I'd be happy to get any questions in post to the gentleman and get you connected to them to have a discussion, maybe offline, if there are any. Again, this session is being recorded as well. We'll have this posted on our social media channels and on our Rosenfield and Company website. So if there are any additional questions, I'll take those via email. I think at this point we're just hitting 3 o'clock. So thank you, gentlemen, both George and Ken, for your time today and letting us pick your brains. It was great having you both. I know our audience as well definitely appreciates your time.
That was a quick hour. I think that was the quickest hour we've had. It was really good.
Thank you. Thank you all. Appreciate it.
Okay. All right. With that, we will conclude today's session. Thank you. Thank you, everybody, for joining.
Thank you.